Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. Well, what do we got going on in the markets today? Well, Dow's up about 100, Nasdaq's down 100. We've made it to the end of the week, and what a week it's been. We kicked off earnings seasons, right? The bank, JP Morgan, comes out, blockbuster earnings. Market goes up a little bit, but we're coming back down already. All right, so where's the market headed from here? Well, earnings season is typically a stronger time of the year, right? So earnings happen every quarter, right? Every quarter, and it takes about 5 weeks during earnings season. Now, most of the mutual funds out there underperform the S&P. They underperform. 85% of mutual funds underperform the S&P. So if you're a long-term investor, well, just stack your money in the S&P. You'll do much better. But if you want to beat the S&P, just keep your money in the market 5 weeks out of every quarter, and those 5 weeks would be during earnings season, and you will outperform the S&P. You will almost double the performance of the S&P. Now, the time you do not do this trade is when the S&P is more than 10% above the 200-day moving average. Now, right now, we're not more than 10% because we've come back in. We had that drop down, right? And the downward trend is still there, right? I mean, we're coming down. We had the July high, then the September high, and now we've got another lower high, and we're probably coming down. Now, the question is, will the recent low hold up? Will that low hold? Will we get a higher low, or will it go a lower low? Now, if we break below the 200-day moving average, this market is going to go into a free fall, but I think that's going to hold up right now. I actually think we're going to get a little bit of a bounce. Now, we may come down a little bit, but I think we're going to bounce up to the 4,500 level on the S&P. We're around 4,330 right now, and I do think that we're going to bounce up to around 4,500 before we resume the downtrend. We're actually in a stronger time of the year. September, a weak month, first 2 weeks of October, weak, and we made it through that time. Now we're coming into the holiday season. The earnings season kicked off, right? That's a stronger time. The holiday season, it typically does not have a lot of crashes. Now, we still got 2 weeks left in October, and as you all know, October is responsible for a couple of the major stock market crashes, so we still could get that. I don't think it's going to play that way this year. We'll see how it plays out. I do think, don't get me wrong, I do think there's going to be a crash. I just think it's going to be next year, and I think we're going to drop about 50% on the stock market. But right now, I've got a price target of about 4,500 on the S&P. We'll see how that all plays out. You probably have a completely different take, and that's all right. Let's get over to the real estate market. Now, in the real estate market, Jeremy Grantham. Now, if you don't know who he is, he's a legendary billionaire investor. Jeremy Grantham, he comes out and he's predicting that we have a plunge in home prices around the world, not just the United States, but around the world, home prices will plunge. This is what he's predicting. He's predicting that we're in a global bubble and prices are going to drop by more than 30%. Now, I'm calling for a 40% drop, so me and Jeremy, we're kind of on the same page. Now, how come we're the only ones on that page? Look at Goldman Sachs. They're saying homes are going to go up by 4% next year. If you want to believe Goldman Sachs, you can. Lawrence Yun, he's the big chief at the NRA. He's saying it's impossible for prices to drop. Now, he does say we could have a temporary dip. A temporary dip. I don't even know what that means. Is 40% a temporary dip? Well, if we come down 40%, we stay there for 5 years. Is that temporary? I don't really know what a temporary dip is. But he says we could have a temporary dip, but it's impossible for home prices to fall. So I don't know what he means by that. But all right, so let's get on to the next person, Sheila Blair. Sheila Blair, you might not know who she is. Some of you will recognize her name. She was the head of the FDIC from 2006 to 2011 during the financial crisis, right? So she has a lot of expertise in bubbles, stock market bubbles, real estate bubbles. She saw them come crashing down, right? In the great financial crisis. Matter of fact, she's writing a children's book about bubbles. It's called Daisy Bubble. But here's what she's saying. She's saying that the real estate market is in a bubble, and the smart thing to do would be to let the bubble deflate. Let the prices come down. Now, if you just bought your home, you don't want to hear that. A lot of people that just bought their home, they really don't like listening to my channel. They don't find it comforting, right? Because I'm telling them they're going to lose 40% on their home. Now, if you listen to Core Logic, over 1 million homes are already underwater. They're already underwater, right? Meaning they owe more on the home than the home is worth. They're underwater. Now, do these people want to see the bubble deflate? No, they don't. They want to be a moon boy. They want to see it go straight up. But anyways, you got differences of opinion. It's a tug of war in the opinions, and only time will tell who's right. I don't know if I'll be right. I'm predicting 40%. Do I know that's going to happen for a fact? Of course not. Of course not. Nobody knows what's going to happen. But do your own research. Make your own conclusions. Don't just listen to me. Listen to everybody. Go listen to Mr. Ramsey. He says we're going to the moon. Okay, so what I do want to talk about today is, well, it's Friday. I got to scare you a little bit, right? So I want to talk a little bit about the elephant in the room. The elephant in the room. Okay. Here's the elephant in the room. The U.S. does have a plan. Now, here's their plan. Print money, borrow money, and spend money like a madman until something breaks. Until something breaks. That's the plan. There's no going back now. There's no turning back. We're going to go until something breaks. That's all we can do at this point, right? So we're going to print money until something breaks. And you know what? I thought it'd be a long time before I see $1 trillion a month printed, but that's what we're printing right now. Just in the last 2 weeks, $500 billion. Don't take my word for it. Go to debtclock.org, USDebtClock.org actually, but $500 billion in 2 weeks. That's $1 trillion a month. That's what we're printing right now. And these are the good times. They're the good times, right? Well, we need money. We're paying for 2 wars, right? We're paying for the Ukraine war, the Israeli war. I mean, if another war kicks out, we'll pay for that one too. We got all this extra money, don't we? We can just send it over to them. We don't have money to fund our government, but we got money to pay for all this war. And there's going to be a lot more war because they don't know what to do because they got in such a mess, right? They're in a mess and they don't know the way out of it. But once you get a loss of confidence in the currency, see what they're doing is they're crashing the currency. But Mike, you don't understand. The currency's strong. The dollar's strong. DXY is up. Mike, we're currency's strong. Go to the grocery store, go to the gas station. Take my word for it, they're crashing the currency. And when you get a currency crisis, how do you bail that out? How do you bail out a currency crisis? Do you print more money to bail it out? Is that how it gets bailed out? No, you can't bail out a currency crisis. That's what's going to happen. We're going to, let's say they do the right thing and they stop printing money. Well, everything starts crashing down. What's the Fed going to do as soon as things start to crash? They're going to print as fast as they can. $1 trillion a month won't be close to enough. They'll be printing 2, 3, 4 trillion a month, and there's no way to pay this back. Now, I'm no genius. I mean, this is just common sense, right? Just common sense. I mean, we got 33 trillion in debt, right? 33 trillion in debt. Just the interest on it this year will be over $1 trillion. But a lot of this debt is still at 1%. When we rolls over, and it rolls over every couple of years, it'll be up at 5%. So next year, the payment goes from over $1 trillion this year to over $2 trillion next year. Now, over $1 trillion, that's already more money than the United States spends on defense. Although defense spending is picking up, the more wars that break out, the more we can spend on that defense. Maybe when you see the interest is going to go up to $2 trillion next year. Maybe we can get the defense spending up to $2 trillion next year. But here's where it's at right now. All right, so we got the interest about $2 trillion. It'll be $2 trillion next year. Okay, we got Social Security and Medicare about $3 trillion. That's 5. Throwing defense at 6, and if defense goes up, that'd be 7. How much do we bring in, Tom? We bring in less than $4 trillion. Now, somebody explain this to me. I know a lot of you are smarter than me. I don't claim to be smart. This is just 7th grade math. Anybody can do 7th grade math, right? But here's what I want you to explain to me. Okay, explain this to me. So if we got 33 trillion in debt, right? And we're going to pay all this money in interest to where we're spending $6-7 trillion a year, but we're bringing in less than 4 trillion. Now, here's what I want you to explain to me. Okay, why are tax receipts dropping? Tax receipts dropping. The amount of money that the federal government's collecting in taxes is going down about 10% year over year. Why is that dropping if we're in this booming economy? The only way tax receipts can drop is if we're in a recession. That means the GDP is going down. They're collecting less money, right? So tax receipts are dropping is a telltale sign that we're already in a recession. Now, they're not going to tell you we're in a recession. They're not even going to figure it out for another 6 or 9 months that we're already in a recession. But when you look back in history, you'll realize that the fourth quarter, we were already in the recession. Fourth quarter 2023, already in a recession, right? Okay, so there is some good news. There's some good news here. The 33 trillion in debt, right? We're going to start paying 5, maybe 6% on that money, right? Who do we pay that to? Who do we pay that to? Well, a lot of people have bonds, right? A lot of foreign countries have bonds. So we pay foreign countries, but we do pay some bondholders. And a lot of you now are getting money on your bank statements, 5% from your bank. My bank's paying 5.5% right now on CDs. And bonds are paying about the same. But who's this money being paid to? It's being paid to wealthy people with, let's say you have $1 million sitting around and now you're collecting 50 grand a year just on your $1 million. So the rich people are getting richer by the payment of the interest to them in the form of paying them interest on their bond holdings. And these people are wealthy people, millions and millions of dollars. So they're adding to their net worth. And who's responsible for this? Well, this is the taxpayer responsible for this because we don't have the money to pay the interest. So the taxpayer has to go farther into debt, and your dollars are going to inflate because we print the money. We print the money to make these interest payments, right? We don't have the money. We print it to make the payments, and this causes inflation to go up, right? And inflation goes up. Who pays? Well, poor people. Poor people. This is the way they transfer the money from the poor to the wealthy again. I mean, the poor person, the loser, the wealthy person, the winner. The biggest gap we've ever had between the rich and the poor. Bigger now than it was in the Great Depression. A lot of people don't realize that. But inflation's not over yet. Inflation is not done yet. Look, if people think that, oh, inflation's done. We gone from 9% down here to 4%. Mike, we're done with inflation. No, we're not. No, we're not. I'm telling you, inflation's going to start running back, especially now that we're printing $1 trillion every month. That is inflationary. That's inflationary, printing this money month after month, $1 trillion, bailing people out. Bailouts is inflationary. War is inflationary. I mean, why is war inflationary now? Let me think. Well, we pay for them all. Technically, I don't even think we're fighting a war yet. I mean, they'll tell you we're not at war, but yet we pay for them all. The 2 wars broke out with the U.S. for some reason. We have to be the ones sending the money to the foreign countries, paying for the wars, right? I mean, that's what we do. We're the United States. We send foreigners money. We don't have enough for our people, but we send it away. So we're paying for these 2 wars. Well, where do they get the money? They don't have it. They have to print it. That's inflationary. That war is very inflationary. And this is going to end bad. This is going to end real bad. I'm telling you. Look, next year, interest payments will be more than Social Security and Medicare. Right now, the interest on the debt is more than the defense budget. This cannot continue. But they're in trouble now. They're in trouble. You see, they're caught in their own Ponzi scheme. They're in this Ponzi scheme, and once they start to lose, well, Ponzi schemes are created with confidence. You need confidence, hence the word con, right? Hence the word con. I mean, our government they make Bernie Madoff look like a Sunday school teacher, right? I mean, our government's running the biggest Ponzi scheme in the history of the world, but they have the confidence that the dollar's still good. Now, I am not one that has that confidence. I don't believe in that dollar. I believe that you should get your money out of the dollar. Now, for me, I put it into gold and silver. I like gold and silver. Now, gold's having a day today, right? Up over $50. Silver's up $1 today. Why? Well, because people people are starting to lose that confidence in the currency. And once that confidence is gone, I mean, the system breaks, it's over. Emperor's wearing no clothes. I mean, you will not go on. You will see the biggest crash in our lifetime. You will see the biggest financial crisis in history, in the history of the world. There's never been this debt, and this debt bubble is going to pop. What's that going to do to your house? It's not going to be pretty what's going to do to your house. I mean, Jeremy Grantham, he may be real conservative with just 30% off. Once this whole financial crisis comes to a screeching halt, you'll get a credit freeze at the banks. There'll only be cash buyers left, and cash buyers aren't going to pay you what people are selling the house up here at the price Billy Bob got. These are the good times. You can still make it out. But once this credit crisis happens, once this financial crisis happens, once these banks start falling over like dominoes, and that's already starting. It's already starting. But Mike, JP Morgan just came out with earnings. They had record earnings. Oh, they have record earnings, but they don't have your money. They've lost your money. Sure, they got record earnings, but they do not have their money. Now, how can I say it? Well, if they had the mark to market, they would be about 50% of the money you put in there, they wouldn't have it. So if just 5-10% of the people want their money back, even as big as JP Morgan is, they go down. Now, mark my words, one of the big banks will go down. Maybe a Wells Fargo, maybe a Bank of America, maybe even a JP Morgan's. It will happen. It will happen. This time next year, this world is going to be so much different than it is right now. Now, don't talk to this stuff to your friends, to your family. They don't want to hear about this stuff. This is for me and you. Look, I get the haters. You know, the comments are going to come. All those moon boys. But Mike, you don't know about MMT, modern monetary theory. We can print as much money as we want. It doesn't do any harm. This is what they taught me in school, right? MMT, we didn't even have that when I was in school. You can't print your way to prosperity. It doesn't work. Never going to happen. It's going to come crashing down. The big elephant in the room is we're going to print, we're going to borrow, and we're going to spend like a madman until something breaks. And it's not going to be that much longer before something breaks. Do the best to protect yourself. I know it's the weekend. I didn't mean to scare anybody. Get out there, everybody. Have a great weekend. But first, give me a thumbs up. Punch the subscribe button. Why not? I'm Tall Mike. Bye-bye now.